This is Camille Renshaw. I am CEO and co-founder of B+E Net Lease, a brokerage firm that helps folks transact single-tenant net lease properties across the United States. We have a bit of a specialty in terms of car wash and gas station, especially since the 2017 tax law passed. I don't want to get ahead of myself, though. With me today is Brian Yawlak. He's with Topchi and Company, a CPA or accounting firm that also has a specialization in this field. Morning, Brian.
Good morning. How are you today?
I'm doing great. I'm sitting in New York City today. Where are you?
So I'm located in northern New Jersey, so not too far from the city.
Most of the clients and lawyers that I know that work with you are here in New York City, but I know you have a specialization nationally.
That's correct. So, for our firm, we're a CPA firm, but we have clients located all throughout the U.S. Majority of businesses are operating in more than one state at a time. That has become, part of our structure and clientele.
That's great. Can you tell me a little bit, if I were a client or if I have a buyer who is looking at a car wash, for example, how do they work with you? What kind of work do you provide?
Yeah, so for clients, what we'll do is two things. One is we'll get involved at the initial stages. So when a client is doing an acquisition, we'll get involved from an analysis standpoint of what the tax ramifications are on the deal that they're looking to purchase. Once that deal comes to fruition, or if they've been a client, then obviously we help them and assist them through the process with any of the tax reporting, planning, and the analysis that goes along with the life of the business cycle.
That's great. If we have a client who maybe hasn't done this before, they would need to get a cost segregation study. Is that correct?
Yes. So, what clients would want to do in the beginning with the acquisition is what you just mentioned is cost segregation study. And what that is essentially is when you buy an asset, which a lot of these deals are, you're buying a building that has a structure that would also be on land. The cost segregation study goes through it and looks at it and says, okay, what are the specific lives of the components? So while car wash is buildings and structures are typically a 15-year life, which are eligible for bonus depreciation, a cost segregation study can take that a step further, where the equipment or any of the other things on premise may be a shorter life, such as 5 or 7 years. In addition, what they would also do is there would be a portion of the property that would be considered land that is non-depreciable.
So let's jump right in. This podcast or video is really about bonus depreciation as it affects the purchase of car wash and gas stations. What in the heck is bonus depreciation? And, I referenced 2017 tax law earlier. What is the root of that? What am I referencing?
Yeah, that is a great question. So the bonus depreciation essentially was federally enacted accelerated depreciation. So in the beginning, back in 2017, which was a grand slam back then, was they opened the law to essentially eligible property could be used property. Before that, it had to be new property. So when you were buying an existing building or structure, none of it qualified, only new property that you essentially purchased. So with the tax law changes and the bonus depreciation, what it allowed you to do was immediately write off 100% of the cost of that asset, which included used property. The way it currently is now is bonus depreciation is 80% 2023 and phasing out 20% until it's completely phased out in 2026.
Yeah, so in 2024, we're at 60%.
That is correct.
Okay. Well, I would love it if we talk specifically about a car wash, because I think that's going to help everybody really know what we're talking about. And as you know, I mentioned to you beforehand, the car wash that we're marketing right now for a company called Mod Wash. It's a sale leaseback, so it's going to be sold with a brand new 20-year lease. It has basically a sales price of around 5.7 million, and it's in Chattanooga, Tennessee. Pretty great location, new build, all those things. It we are marketing it as having the potential to do a cost seg study, and the buyer will benefit from bonus depreciation. If we're talking about that, how does the cost seg impact that specific property? Let's assume it actually sells for $5 million, just for a round number to make your math on the fly easier. How does it work? How does the math work?
Yeah, so, with the specific example, if you're talking about a $5 million purchase and you have a cost segregation study performed, ideally what would happen from this is you're probably talking somewhere generally 70 to 90% of probably the purchase price would be eligible for bonus depreciation. So, assuming it was $5 million and it was at the higher end at 90%, you're talking $4 million of a potential write-off. And then 80% on top of that would be the reduction, would be the amount that would be depreciable of that $4 million.
And the 70-90 rule that you're referencing is really, how do we split the land and the building? Is that the percentages?
Yeah, that would be exactly the case. How you be for the portion of the structure that would be attributable to land, or potentially there may be something else on the property that's not connected to the car wash, that may have a commercial life, maybe over 39 years. It all depends on the acquisition of what's been acquired.
Yeah, the example that I often give guys, just so they can do the math quickly in their head, is a $10 million car wash, which there aren't many of. So you might be thinking, really, that's 2 car washes, but for simple math, and use the 80-20 rule. So it's 80% of that. So 8 million of that is subject to the bonus depreciation, and then 80% of that. So 6.4 million. In the case of the 5 million, it's half of that, right? So 3.2. But just for the folks who are listening, that's kind of, I think, in quick numbers, quick, dirty numbers that you definitely need vetted by somebody like Brian. But I think that's helpful to think about. And just in case you're trying to do an estimation, because I know a lot of the folks will now go pull up this Mod Wash or another Mod Wash, which is a great brand, so that's a good one to consider. But there's Mr. and Zips, and there are a lot of brands out there to take a look at, and you're thinking, why would I buy one versus another? And this quick, dirty math is a good way to sort of estimate what your benefit is going to be post-close. And to be clear, that tax benefit will take effect if they were to close in Q4 of 2023. They would get the benefit in this tax year, correct?
That would be correct. So at the point they purchase it and they've essentially placed it into service, that would be the date that would start the clock on when the asset is placed in service.
So if I buy a $5 million car wash and it gets the 80-80 write-off that we just talked about, I get a $3.2 million write-off in 2023?
That would be correct.
That's amazing. So that explains why everybody is rushing into the car wash segment and trying to buy car washes. So, especially when you can buy them and they're in the 6s from a cap rate perspective, it's great returns even post-close.
Exactly, and the timing element of it, obviously, with bonus depreciation phasing out year after year, there's more of a need or urgency to obviously close a deal sooner rather than later.
Yeah, we're definitely hearing from folks that maybe in Q1 or Q2 have no idea what their tax, obligation is going to be in a given year. Like in Q1, Q2 of 2024, there's definitely still folks buying in the segment, but there's definitely a rush in Q4 when they know what their tax obligation, or have a good estimate of what it is for that given year. We're seeing it right now, just as buyers are starting to flood in. So as we talk about that write-off, a natural question that I get that I think is a little complicated is this, the nature of passive versus active income. Can you talk about that and what role it plays in bonus depreciation?
That's a great question. So bonus depreciation, it would be at an entity level, essentially deduction. It would flow up to the individual investors. And the passive versus essentially active would be, what is their status in the deal? So what passive would mean is essentially hands off. They have no decision-making in the business. They're not participating in the business. They're completely passive. What happens from them from a tax perspective is those losses are then only eligible to offset other passive income. So in the case of those types of investors, if they had other businesses that they were hands off on and they were generating passive income, they would be able to offset the passive losses on the car washes against the passive income generated on the other businesses. On the other hand, if they do not have, passive income, what would happen is those losses would carry forward indefinitely until either one, you had passive income, or two, you disposed of the activity. Passive income should not be confused with portfolio. So, portfolio would be like your interest, dividends, capital gains, stock sales. Passive income is strictly going to be related to other passive activities. For active, essentially, if it's someone that's buying a car wash and they're actively managing it, they're spending the hours, there's certain tests to determine whether or not you qualify, the benefits become much greater because then that activity for them is not considered passive, it's considered non-passive. And there's a great deal of opportunities for utilizing those losses against other sources of income, which may be, a spouse's earnings, it may be other portfolio income, in terms of what can be, beneficial or offset.
Yeah, and as I dive into these conversations, I think at first folks are like, wow, this is going to be active income. I don't have active income, or this is going to be passive income. I don't have passive income. But generally folks that would participate in this and it would qualify as passive income have a lot of other passive income in my experience. And people that this would qualify as active, they have a lot of active income, just that tends to be sort of the nature of the transactions that you're participating in. And we've found again and again, there being sort of objections or concern around this. But when folks sit down with a CPA like you, it tends to have a logic to it that makes some sense.
Yeah, that's exactly the case. When you have the CPA involved and they know your full picture, from your perspective, then they can easily guide you and tell you what the benefits of, doing a deal like this would generate from a tax saving standpoint.
So let me be clear, if I get a $3.2 million write-off in 2023 and it is passive income and I only have $1 million, I'm sorry, it qualifies under the passive income clause, and I only have actually $1 million in passive income in 2023, I won't lose that other 2.2 million, correct, in terms of loss?
That's correct. So any of the excess would essentially just be a passive activity loss carried forward, and then you would look at the same situation again next year. What is your passive income compared to your passive losses? And it would continue, year after that.
So I could potentially do a transaction in Q4 that gives me a write-off for many, many years, like prevents me from paying excess tax for many, many years. That's very cool. Very, very cool.
Yes, definitely. So for one of the things with active participation and transforming these potential losses to non-passive, there's a great deal of potential limitations at the individual level, depending on everyone's individual situation. So while it's possible that you can offset this income against other portfolio income, spouse's income, there's also limitations in place to make sure that they're essentially what's not an excess business loss. Effectively, if you do have a limitation, that limitation or that excess would just carry forward. But the rules are very complicated. It needs to be discussed, obviously, with your CPA or tax advisor that knows your overall tax picture in order to, advise properly on what the ultimate benefit you'll get in a given year, as opposed to how much of that benefit would be deferred to future years.
Makes sense. So another question that we get is, I buy this mod wash. Let's say I buy it at a 6.5 cap. That's kind of, today's market. And then as we all hope, interest rates dip at least a little bit next year, cap rates dip a little bit, and I'm able to sell this thing sort of maybe even unexpectedly in 2 or 3 years for a 5 cap. I'm making all these numbers up. But, and I want to go ahead and sell then. I understand the scenario where I own this the whole 20 years and ModWatch just keeps paying me rent and I get escalations on the rent. But how do I exit the property without reclaiming, that tax obligation in, 2-3 years if I have the good fortune that it's worth more at that point?
Yeah, so I mean, the most common exit strategy that we have seen is essentially the investor, the person purchasing this, will perform a 1031. What a 1031 is essentially it would defer the gain that will allow you to acquire a replacement property. And then when that replacement property down the road, you have the option of obviously performing another 1031 or ultimately recognizing the gain at that point.
We actually have several clients right now that are doing just that. They bought, they're again fortunate enough to have bought car washes a couple of years ago. They're selling them sooner than they thought because right now, the cap rate is better. They bought before the 2017 law, for example, and so they bought it like an A cap. Now again, they can sell in the high sixes from a cap rate perspective, and so they want to be able to go buy something with more term or diversify, that kind of thing. And the 1031 they've been utilizing just feels like any other transaction. Nothing different about this.
Exactly. I mean, whether it's a car wash or it was a regular rental, real estate piece of property, it's the same way. At the end of the day, the one caveat to keep in mind would be is, if you have a cost segregation study prepared and you have components of it that are a shorter life, such as 5 years, and they're considered tangible personal property, that's not essentially exchange eligible. So it's possible you may have recapture on that component of it. However, with the replacement property, you have the option of performing another cost seg so that you may have, additional bonus depreciation that would essentially offset any of that recapture income, depending on how you structure it.
So effectively use the same trick on the next property. That makes
Exactly.
sense. That makes sense. It seems like that cost segregation study will be really important to make sure that you're affecting things correctly from a tax perspective. One thing that we've seen as well is that if someone's buying or has bought a $5 million car wash, that the next property will be bigger, 7 million, 10 million, something like that. Their equity has grown, so they're able to do that utilizing the same level of debt roughly that they did on the first one. And then they get more tax benefits, and anything they have depreciated, they sort of cover by having a larger asset. Obviously, they get more rent from it too. The NOI increases, so yeah.
Yeah, that generally is you're always essentially upgrading on the next 1031 or the replacement property. One, because you need to replace the existing debt with the same amount of debt to not trigger any additional gain or boot, as well as to make sure you have enough equity in the new property.
So we've heard about other types of exits. I think they're not, they're possible, but maybe they're a little more laborious and certainly from a legal perspective are a little more complicated. But I think drop and swap, am I saying that correctly?
Yeah, that is correct.
And the other one that gets mentioned quite a lot, but generally this is for larger portfolios or UPREITs. It doesn't have to be larger, but there'll be some REIT that they want to contribute their property to, and they can participate in that and then get shares in that. Ultimately provides an exit as well.
Yeah, and every exit, you're obviously going to have various different avenues or opportunities. The 1031 is obviously the most prominent, but depending on the structure, depending on the dynamic of the members that are in the structure, there may be different goals. So there are various other different strategies that may be better suited, but the 1031 is obviously the most common.
So to step back to the math a little bit, because I mentioned debt just now, and I realized I forgot to ask you this question earlier. If we've got a $5 million property and utilizing the rough math that we said earlier, and it's about a $3.2 million write-off, if I go and get 60%, 65% debt, and so I'm only bringing $2 million to the property roughly in terms of equity, and I get a $3.2 million write-off, I'm getting something like 150% write-off relative to my equity. This is very rough math, but is that an appropriate way to approach the debt? It's really only about the equity as it relates to the write-off that should be mathematically considered in your ROI, correct?
That is correct. One of the great things about obviously the debt or the leverage is, depending on the structure that is utilized to acquire the car wash, what we kind of talked about before about bonus depreciation, passive versus non-passive, depending on the structure and the debt that's been acquired, there's certain rules which is essentially at risk. So, depending on how the debt is acquired, whether or not you're personally at risk for it, that will lead into the equation of how much of a loss that, potentially would be eligible for an individual to take.
So we've seen, for example, recently in Florida, when we were selling Mr. Clean, we had a buyer go out and, everybody is always trying to get the best debt, but he was actually not as concerned with the interest rate It's really interesting in this case. He was more consumed with the LTV and going out and finding something so he could get a 70% LTV. And the interest rate was slightly higher, but it was really just to, crank up this part of the return. Because it's really, in the case of bonus depreciation, what we coach folks on is it's really more about your after-tax return rather than your before-tax return. You certainly want to look at both. Because after you get the big pop in the first year, you want to make money, but that first year is vital.
Yeah, so no, definitely key. And, you kind of hit the nail on the head where you really have to look at both components, the before and the after tax, return when you're, considering these avenues and these opportunities.
So do you have any advice for folks in terms of when they're considering this that I haven't mentioned, that you would ask me if I were presenting this mod wash, for example, to you to purchase? What handful of questions should I consider upfront?
Yeah, that's a great question. So, the very first thing is obviously going to be, what are they looking at in terms of what is the purchase price? The second component of it is obviously their individual tax situation. So, if their conversation is obviously with their CPA that's been handling their internal businesses and they know that picture, that makes it nice and easy to determine the analysis and what the potential benefits of doing a deal like this would be. If they don't have a CPA or a tax advisor, that would be their very first step, is to get one involved and have to be brought up to speed pretty quickly, knowing the overall individual tax returns, other business entities that they have, so that you can get a complete tax picture to see, what the ultimate benefit's going to be in terms of if you pull this deal off or not.
Yeah, we've found that some CPAs don't have much experience with this and others do. Candidly, that's why we know each other, right, Brian, is that you are an expert in this field and really helpful to our clients. And we've had other CPAs who are wonderful in other areas of tax law, but you do kind of have to understand the nuances of this in order to maximize the returns. One additional question. Can I utilize bonus depreciation at the state level, or how does this impact my state taxes?
Yeah, that's an excellent question, because as we all know, we have federal taxes, but we also going to have a state level for most people. Generally, across the board, most states do not allow bonus depreciation. So that becomes one of the timing differences when you talk about, federal versus state tax differences, which becomes also a greater benefit of having a cost segregation study. If now you're talking, a car wash that, generally would be 15 years, and maybe you can break down a component to 5 years, that becomes a lot more beneficial at the state level, knowing that you can't take bonus depreciation, but you have more eligible in a shorter time bucket.
Very helpful. Very helpful. Well, Ryan, I really appreciate your time here. I think the first step, if somebody is considering a car wash purchase or a gas station purchase, is really just to reach out and have the conversation, I assume. Is there anything that they need to have in hand to start that conversation with you?
No, I mean, pretty much the first thing is picking up the call to have the conversation, to find out the details of, the rough aspects of what the deal looks like. And then, knowing their overall, tax picture between the two together, work with clients to, put forward, the best analysis and, have them have the best information available so that they can either proceed or not proceed based on, their preference.
So, Brian, final question that I know is on many of our listeners' minds is, hey, I want to close on a car wash in Q4 2023 by December 31st. How do I make sure that I've got everything lined up correctly? Obviously won't know all the math and know all the details until I actually close, which might be literally December 31st. How soon or at what juncture do I engage Brian? How soon? What's too late? How do I make sure I did this correctly, and when to engage you?
Yeah, exactly. I mean, what people should be considering is at the point they're starting the process, they should be reaching out to their CPA tax advisor immediately. There are things that can be done after year end, such as the cost segregation study that can be done after the purchase. Just needs to be completed before the tax return is filed. Tax returns can go obviously on extension, but really in the beginning, they do want to at least have that initial conversation with their CPA or their tax advisor so that they can talk about the general, benefits and the numbers of, hey, if I close this deal now as opposed to next year, and I lose out on a 20% difference of bonus depreciation, is it impactful for my current situation or is it not? So sooner rather than later, you want to pick up the phone or send out an email or a text to your trusted advisor.
That's great. Well, thank you, Brian. I really appreciate your time. I think this is very helpful. It's a lot of blocking and tackling on how this works, but I know folks understand there's a massive benefit here, but they're kind of confused about the details. So hopefully this starts to iron it out. I absolutely agree, though, that it comes down to the specific property, the specific cost seg, that taxpayer, like you've got to get into the weeds. So I would say folks need to reach out. We'll provide your contact information with this just as soon as they know they're seriously considering the purchase.
Yeah, thank you very much for having me on today. It was an absolute pleasure. And, it's a great topic when you think about car washes and, where can you save on taxes? That's usually on everyone's mind.
All right. Thanks, Brian.